Every week, the United States Treasury borrows roughly $50 billion. Not over a year, not over a quarter, every week. By the end of fiscal year 2026, that borrowing is on pace to push the federal deficit toward $2 trillion, with national debt now exceeding the entire size of the American economy. That alone would be a familiar story. Debt warnings have circulated in Washington for decades, and audiences have learned to tune them out. But there is another number moving in the background, one far less discussed and far more revealing. China has spent the last several years quietly doing something a confident creditor does not do. It has been selling. Chinese holdings of U.S. Treasury bonds, once well above $1.3 trillion at their peak in 2013, have fallen to somewhere between $650 and $690 billion. In 2026, the lowest level since the global financial crisis of 2008. At the very same time, China's central bank has been buying gold, not for a month, not for a quarter, for 17 consecutive months. Two trends moving in opposite directions inside the same relationship. One government borrowing at a historic pace, another quietly stepping back from funding that borrowing while stockpiling the one asset with no government attached to it at all. Is this simple financial prudence a cautious hedge against currency risk, or is it something closer to positioning a rival power preparing for leverage it hasn't needed yet? What most people miss is that these two trends didn't start this year. They've been converging for over a decade, and 2026 may be the year they finally collide. To understand why, we need to look first at exactly what's happening inside America's own finances. Start with the fiscal year just closed. In 2025, the United States ran a deficit of $1.7 trillion, roughly 6% of the entire American economy. That number was supposed to be the high point. Instead, projections for 2026 are worse. The Treasury Department's own estimate puts the figure at $2.065 trillion. The Congressional Budget Office projects $1.9 trillion. Primary bond dealers, the banks that actually buy government debt at auction, forecast $1.95 trillion. The range varies, but the direction does not. Debt held by the public has now crossed 100% of GDP, and under current law, the Congressional Budget Office projects it will reach 120% by 2036, surpassing the previous record of 106% set in the aftermath of the Second World War. For the first time in modern history, the cost of simply servicing that debt net interest payments has overtaken the entire defense budget, exceeding $1 trillion a year and projected to double again within a decade. Several actors sit inside this picture. Congress and the Treasury control spending and borrowing. The Federal Reserve sets the interest rate environment that determines how expensive that borrowing becomes. And on the other side of the relationship sits Beijing, the People's Bank of China, and the State Administration of Foreign Exchange, the institutions that decide how much of China's reserves remain in American debt at all. The immediate backdrop matters too. The 2025 Reconciliation Act added significantly to projected deficits. Higher tariffs have offset some of that damage through increased customs revenue. And looming ahead, the Bipartisan Policy Center projects the government will hit its statutory debt limit again sometime between late 2026 and mid-2027, another forced negotiation, another test of political will. The Government Accountability Office has already called this trajectory unsustainable. The Committee for a Responsible Federal Budget and the Peterson Foundation have said much the same in less diplomatic language. But here's the deeper issue. These numbers are the visible symptom. The real story is about who is financing all of it and who is starting to walk away. To understand why America arrived here, we have to go back further than this decade. To understand today's numbers, it helps to trace three separate stories that happen to converge at the same moment. The first is American. The United States has not recorded a federal budget surplus since 2001. In the 25 years since deficits widened through two prolonged wars in Iraq and Afghanistan, exploded during the 2008 financial crisis, and then widened again dramatically during the COVID-19 pandemic. Each crisis became an excuse to borrow more, and each round of borrowing quietly reset what counted as normal. Over the past 50 years, the average annual deficit has run at about 3.8% of GDP. Today, it runs at 5.8 to 6% in years, without a war or a pandemic to explain it. This is not a story of one administration, it is a bipartisan habit decades in the making. The second story belongs to Beijing. For years, China ran enormous trade surpluses with the United States, exporting far more than it imported. Rather than let that surplus sit idle, Chinese authorities recycled it using the dollars earned from trade to buy U.S. Treasury bonds. It was a mutually reinforcing arrangement. America got a reliable buyer for its debt, and China got a safe liquid place to park its earnings while keeping its own currency competitively priced. That relationship peaked in 2013 when Chinese Treasury holdings crossed $1.3 trillion. For a decade afterward, it looked like a permanent fixture of the global financial system. Then came the third story, and it changed everything. In 2022, following Russia's invasion of Ukraine, the United States and its allies froze roughly $300 billion of Russian central bank reserves assets Moscow had assumed were untouchable simply sitting in Western financial institutions. To understand why 2026 feels different, we need to go back to that single moment, because that was when the rules quietly changed. Reserve managers in Beijing and in a number of other capitals drew an unmistakable conclusion. Dollar-denominated assets were not, in fact, neutral or apolitical. They were politically contingent. Under the right circumstances, they could simply be switched off. That realization did not trigger a single dramatic reaction. It triggered a slow, methodical one, the kind that shows up not in headlines, but in reserve composition data quarter after quarter. There is a parallel vulnerability worth noting here, one rooted in an entirely different kind of neglect. Until the 1980s, the United States led the world in rare earth production. Over the following decades, that capacity wasn't seized by Beijing through any single deliberate act against America. It was simply ceded as processing shifted to China because it was cheaper, and nobody in Washington treated the migration as a strategic risk. Three threads: American fiscal drift, Chinese reserve accumulation, and a 2022 shock that redefined what a safe asset even means. With that foundation in place, we can now look past the headline numbers and into the actual strategic calculus unfolding on both sides. To understand what Beijing is actually doing, it helps to separate two questions that are often collapsed into one. Is China abandoning the dollar, and is China building leverage over the countries that depend on it? The evidence points to a clear answer on the first question and a far more uncomfortable one on the second. Start with the reserve dimension. China's central bank has purchased gold for 17 consecutive months, pushing gold's share of total reserves above 9% for the first time. That sounds like a rejection of the dollar system. It isn't, not really. The yuan remains a minor player in global reserves, tightly controlled, not freely convertible, and nowhere near ready to replace the dollar as the currency the world trades and saves in. What's happening is narrower and more defensive than de-dollarization, as a slogan suggests. It's hedging. Specifically, it's hedging against the exact scenario that played out with Russia in 2022, the freezing of sovereign reserves as a tool of political pressure. Add to that a second, more American source of anxiety: repeated controversy over the independence of the Federal Reserve itself. When the institution managing the world's reserve currency looks politically unstable, foreign central banks don't need a theory of dollar collapse to justify diversifying. They simply need to manage risk the way any prudent institution would. Now consider the second layer, and this is where the story sharpens considerably. Beginning in April 2025, China introduced export controls on a handful of rare earth elements. In October 2025, those controls expanded dramatically, modeled explicitly on America's own foreign direct product rule, the mechanism the U.S. has long used to restrict semiconductor exports to China. For the first time, Beijing turned that same legal architecture back on its source. A tense standoff followed, briefly suspended after the Busan summit in late October, only for a new licensing catalog to expand controls again in January 2026, and for targeted actions against specific American rare earth companies, including MP Materials and USA Rare Earth, to follow in June. Here is why this matters more than the Treasury numbers. China controls roughly 90% of global rare earth processing capacity, not raw material extraction processing. The complex capital-intensive separation of chemically similar elements into usable industrial inputs. That concentration makes rare earth controls a genuinely asymmetric weapon. Restricting exports costs China very little. The pain lands almost entirely on the importing side, on defense contractors, semiconductor manufacturers, and electric vehicle producers who have no comparable alternative supply chain to turn to. Analysts at institutions like CSIS describe a consistent pattern behind these moves: escalate, then partially suspend; tighten, then pause. The current suspension holds through November 2026. But, as one analysis put it, this is calibrated leverage, not abandoned as a concession, but held in reserve ready to be reintroduced if negotiations sour. Even the diplomatic language surrounding the 2026 Beijing summit reflected this ambiguity. Washington described China as having agreed to resolve mineral shortages. Beijing's own statement spoke only of both sides continuing to study and resolve each other's concerns, a far less binding formulation. This is where everything changes, because the real leverage isn't sitting in the bond market at all. It's sitting inside a choke point. Most Americans have never thought about the refining stage of a supply chain most people assume is simply about digging metal out of the ground. None of this requires China to attack American finances directly. If U.S. deficits keep widening, the Treasury needs to issue more debt at precisely the moment one of its largest historical buyers keeps stepping back, a straightforward supply and demand mismatch that pressures yields regardless of anyone's intent. The public narrative is China dumping treasuries. The strategic reality is something slower and more deliberate. A multi-year program of hedging and leverage building, not a single dramatic move. It's worth being fair to the counter-argument here. China's treasury holdings represent only about 7% of total foreign-held U.S. debt out of a market worth nearly $9.5 trillion. Many economists argue that Chinese selling, gradual as it has been, isn't large enough to be the primary driver of any future fiscal stress. The deficit itself remains the dominant variable. America's spending choices, not Beijing's reserve strategy, are what ultimately determine the outcome. Both things can be true at once. China's financial positioning is modest in scale, but strategically coherent. Its mineral leverage is small in dollar terms, but disproportionately powerful in effect. Understanding this dual leverage financial hedging paired with a genuine industrial choke point changes how we should read everything that follows, both for America and for the wider world. Every trend examined so far has a ceiling, and it's worth naming it plainly. Researchers at the Penn-Wharton budget model estimate that U.S. federal debt cannot rationally exceed roughly 210% of GDP, a level beyond which no realistic tax increase on labor income could cover the interest payments markets would demand. That ceiling is distant. Under current projections, the country isn't approaching it within the next few years. But it is real, and it reframes today's 5 and 6% deficits not as an isolated budget dispute, but as movement along a road that does eventually run out. Long before that outer limit arrives, though, the more immediate damage is visible in what rising interest costs are already displacing. Every additional dollar spent servicing debt is a dollar not available for defense modernization, infrastructure, or the kind of discretionary spending that once gave Washington flexibility during a crisis. That's the domestic consequence. The global one is arguably more consequential because it is unfolding in real time in the decisions other governments are making right now. Japan, Australia, and the European Union are not waiting to see how the U.S.-China relationship resolves itself. They are independently accelerating their own critical minerals diversification through the U.S. State Department's newly launched FORGE initiative, through the Older Minerals Security Partnership, and through a critical minerals ministerial in February 2026 that brought 54 nations to Washington specifically to confront the problem together. That is not a fringe concern anymore. When over 50 governments organize around a single vulnerability, it has moved from analyst warning to policy consensus. The stress test has already begun, in fact, and the early results are not reassuring. Rare earth and related mineral prices have spiked as much as sixfold in some categories. European firms' licensing approval rates for Chinese rare earth exports have fallen below 25%. These aren't hypothetical projections, they are observed disruptions happening now before any genuine crisis has even arrived. So, who benefits from this arrangement and who bears the cost? China doesn't need a decisive victory to come out ahead. It needs optionality, the ability to apply pressure selectively at moments of its choosing without ever needing to escalate to outright confrontation. The United States retains the world's reserve currency, and that status isn't disappearing soon, but it is experiencing something subtler, a slow erosion of the unquestioned automatic demand for its debt that once made deficits nearly costless to run. And middle powers, Australia, Japan, the Gulf states, even Malaysia and Thailand, find themselves with genuine new leverage, courted by both sides as alternative supply chains and alternative buyers of debt become strategically valuable in their own right. But that isn't the most important development, because while public attention stayed fixed on bond markets and treasury auctions, the real choke point was being constructed somewhere else entirely, in refineries, licensing offices, and export catalogs, far from the headlines that usually define this story. Put the two forms of leverage side by side, and the asymmetry becomes obvious. China's treasury sales remain a small fraction of the total market, tactically significant but not decisive on their own. Its mineral leverage is a different order of instrument, entirely disproportionately powerful relative to its cost and still expanding. All of this raises the obvious question: where does it actually go from here? No one can say with certainty which direction this story takes, but the range of plausible outcomes is not infinite, and laying them out clearly is more useful than pretending to predict the future. The first possibility might be called managed drift. Congress continues doing what it has done for years, passing incremental fixes, patching the debt limit at the last possible moment, occasionally gesturing at spending discipline without fundamentally altering the trajectory. Deficits stay elevated, but market confidence holds because global capital still has nowhere better to go. Meanwhile, China continues its gradual diversification, more gold, cautious treasury reductions, without ever forcing a decisive break. This is the least dramatic outcome, and arguably the most likely one, precisely because it requires no one to make a hard decision. The second is a structural fiscal correction, and it typically doesn't arrive by choice. It arrives through a market-forced event, genuine stress in a treasury auction, a credit rating downgrade, a sudden spike in borrowing costs that Washington can no longer ignore. Painful in the short term, this path could ultimately prove stabilizing, forcing the kind of bipartisan fiscal reform that decades of warnings have failed to produce voluntarily. Crisis in this scenario becomes the catalyst that political will alone could not be. The third scenario centers on minerals rather than money. If Phase 2 rare earth controls are reinstated once the current suspension expires in November 2026, the effect would land quickly, and specifically acute strain on defense supply chains reliant on rare earth magnets and coatings, forcing emergency reshoring efforts at considerable cost. CSIS estimates genuine mineral independence would require somewhere between $30 and $50 billion deployed over 5 to 7 years. That is the price of unwinding a dependency that took decades to build. The fourth path is the most optimistic and the slowest to materialize: structural diversification actually succeeding. Western capital, channeled through frameworks like Forge and the Minerals Security Partnership, builds credible ex-China processing capacity by 2028 to 2030, meaningfully diluting Beijing's leverage over time. It's a real possibility the investment is already underway, but even its strongest advocates acknowledge it operates on a multi-year timeline that offers no protection in the near term. Two dates are worth marking now. November 2026, when the current rare earth suspension expires. And sometime in late 2026 or into 2027, when the U.S. debt ceiling forces another confrontation. Both are concrete, both are near, and both will offer real signals about which of these paths the world is actually on. It's worth being honest about where genuine expert disagreement remains. Economists differ sharply on how much weight to assign Chinese financial behavior versus America's own fiscal choices as the true driver of any future crisis. That disagreement isn't a flaw in the analysis, it reflects real uncertainty that no outline should paper over. The next 12 to 18 months may decide which of these paths the world ends up on. Whichever direction unfolds, one thing is already clear by looking at where things stand today. Return for a moment to where this story began. America, borrowing $50 billion a week. China, quietly stepping back from funding that borrowing while stockpiling gold instead. At the outset, that juxtaposition looked almost like a mystery coincidence, prudence, or preparation. It no longer does. What the evidence actually supports is neither conspiracy nor coincidence. It's something more sobering than either. This is not a story about China attacking American finances. It's a story about America's own fiscal choices, decades of deficits that outlasted every administration that campaigned against them, creating a structural vulnerability that a patient calculating rival happens to be well positioned to exploit. Not through confrontation, through waiting, through 17 months of gold purchases, a rare earth licensing system built and calibrated over 3 separate escalations, and reserve decisions made quietly, 1 quarter at a time. 2 dates now sit ahead, and they are not abstractions. November 2026, when the rare earth suspension expires, and sometime in late 2026 or 2027, when the debt ceiling forces Washington's hand once again. One budget analyst describing the fiscal picture months ago called the country's direction sleepwalking off a cliff. These 2 dates are the next moments that phrase gets tested against reality. It's worth ending without false inevitability. The United States still holds the world's reserve currency. It still commands the deepest, most liquid capital markets on Earth, advantages no rival has managed to replicate, and none will replicate soon. So the real question was never whether Beijing could force a crisis on its own terms. It's whether Washington's own political system can act before one becomes unavoidable.